Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. I'm really excited about today's podcast, and only an investing nerd like myself would probably say that, but the name of the session that we're doing today, the podcast, is Mitigating and Hedging Illiquid Portfolio Risk, a discussion on portfolio construction and hedging. And although it says illiquid, because that's going to be unique for many of you in terms of hedging that kind of risk, we're also going to cover broadly, as I noted, some portfolio construction and hedging. Perhaps, I think we'll have the time, even on more classic liquid securities. Our special guest today is someone that I've known for a couple of years. That would be Mark Anson. He currently is CEO and CIO for Common Fund. Many of you are already familiar with Common Fund, one of the oldest and most well-established and successful of the organizations in the alternative investment community. Mark, welcome to the show.
Thank you. Thank you for having me on today.
Oh, it's really a pleasure. And to give people a little bit of context to our discussion, this is really an important topic. Again, if you look at it from a family office perspective, these are families that are already very, very wealthy. In other words, very, very rich. Yeah, they probably want to grow their wealth. So being a successful investor is, of course, important, but they really want to hedge and mitigate what could be black swan or significant risk. And we kind of saw it happen in COVID-19, but the public markets bounced back for a variety of reasons incredibly well. A little bit more challenged in some private markets, mainly some aspects specifically of real estate, but effectively the ability for successful investors and families to hedge risk. And having your background, and we really don't do much on bio reads, but Mark's background is incredibly extensive, including a significant investment professional for one of the largest, most iconic single-family offices in the world. So Mark, again, it's great to have you on the show. Why don't we start a little broadly to kind of lay the foundation of our discussion today? And that would be, can you hedge the liquidity premium associated with illiquid assets? A lot of people don't think that you can.
Great leadoff question. Before I begin, a couple things I'd like to say. First, I am speaking today as Mark Anson. So not in my official capacity of Common Fund, but the opinions and ideas I express today will be my own. And the second thing I'd like to say is, as we all shelter and work from home, as we battle the crisis known as COVID-19, we're also keenly aware, I think, of the social unrest in our country right now. So I just hope everyone is safe and healthy, wherever you're at. With that, let's turn back to the main question you asked. One of the problems with hedging the liquidity risk or the illiquidity premium is it's so hard to identify. And there's all sorts of rules of thumb that if you talk to people, they'll say, well, the liquidity premium should be about 300 basis points over the public equity markets. In other words, that's the additional amount of return you should expect for locking up your capital in private equity or venture capital or real estate or other illiquid asset classes. There should be some additional risk premium for that long-term application of capital. And that risk premium should be over and above what you can get in the public markets. The problem is how do you identify it? Or does it actually exist? So several years ago, back in 2017, I actually published a paper on this topic, simply titled Measuring Liquidity Premiums for Illiquid Assets. And it was published in the Journal of Alternative Investment, so you can all pull it down and read it. But in that paper, I identified a liquidity premium. And so you can, in fact, identify it. And if you can identify it, you can then track it. If you can track it, you can then have some sense of how much value it adds to your portfolio over long periods of time. So as a data point, long-term average of the liquidity premium going back 20 plus years is about 3.5%, which in fact is not too far off from the general rule of thumb estimates or finger of the wind in terms of what people think they should earn from their illiquid investments. The problem with the liquidity premium is that you can't capture it passively. Nowadays, there are hundreds, if not thousands, of ETFs, exchange-traded funds out there that allow you to capture various risk premium. You can capture market risk premium, small cap risk premium, value, growth, etc. But there is no ETF out there or index fund that allows you to conveniently capture the liquidity premium. The only way you get that liquidity premium is by locking up your capital in long-term illiquid investments. So that's part of the problem. The other thing too is when you think of liquidity premium, what is it? It's actually an amalgam of many different things put together. Part of it, when you think of private equity and venture capital, is it's a better governance model with a private company. If you think of private equity, what they do is they have a single shareholder, which is the private equity company, that takes seats on the board, puts in the pay metrics for the executive management, and is a very active shareholder. It's a perfect example of good corporate governance. The same thing for venture capital. So part of liquidity premium is just a better governance model. Part of it is the better access to financing that a private equity or venture capital firm can get that a standalone company itself. Part of it is the operational improvements that venture capital or private equity bring to startup companies or mature companies. And then the last part is this long-term view outside of public financial statements. So again, the liquidity premium is this amalgam of all these other bits and pieces. You can't grab at it through an ETF, and that's what makes it so difficult to hedge, is first identifying it, understanding what it is, and then figuring out, are there ways to hedge it? So that was a very long introduction. The answer is that there are ways to hedge it, but they're all imperfect. Let me stop there. We can get into some of the details, but that's sort of an overlay of what we're talking about.
Yeah, no, that's a very good foundation. I would say maybe two follow-up questions from that. And I know the first one you covered a little bit, but how do you capture that? And then obviously the follow-up, and I know it's imperfect, but I guess the billion-dollar question, how can you hedge it?
Sure. So again, you capture liquidity premium by locking up your capital in a illiquid asset class, private equity, venture capital, real estate, et cetera. You simply cannot collect that liquidity premium in a passive fashion. So you cannot buy an exchange-traded fund or an index fund to capture it. You do have to actually invest. And then you have to ensure that you're investing with the right managers, which is why private equity, venture capital, real estate have so many quartile ranking groups out there that will rank a private equity fund or a private equity manager vis-a-vis their peer group. Because the way to get that liquidity premium is investing with the first or second quartile managers. If you can't do that, then it's a loser's game. Now back to how you hedge it. One of the key issues, again, is if you cannot hedge it directly, then you have to hedge that liquidity risk or liquidity premium indirectly. And what that does is that brings into the portfolio something called basis risk. And basis risk simply measures the gap in calibration between the hedging vehicle you're using and the actual risk you're trying to hedge. If you're trying to hedge the S&P 500, that's pretty simple to do. You can short S&P 500 futures. You can short S&P 500 ETFs. You can get a pretty close 99.9% effective hedge if you're trying to hedge the public stock markets. But if you're trying to hedge a part of your overall portfolio called private equity, you're going to have to pick some instruments that are not perfectly calibrated to your underlying portfolio. And so you'll bring in this basis risk. It's the delta or the gap between the economic up and down movement of your hedging vehicle and the actual underlying movement of your illiquid portfolio. And so part of the goal is to try and minimize that basis risk in whatever you use to hedge your private equity portfolio, as well as trying to minimize the cost of the hedging. So if you have an XY chart, on one side, on the Y-axis, you want to minimize the basis risk. And then on the X-axis, you want to minimize the cost. And that's our goal today, is to talk through what are some of the vehicles that you can use to do that with. So again, that's sort of the overlay about how to go about this.
Before we move on to really diving into that part of it, we'll take a pinch of a step back when I asked, how do you capture it? And it is an illiquidity premium by investing in private, less efficient, quote unquote, companies where it's not like the public markets for a variety of reasons, from research to liquidity. It's more nuanced. And that is changing to a degree. But like you did say, venture capital, private equity, real estate, venture capital is going to be dominated by US companies, somewhat dominated, obviously, by Silicon Valley. And let's be honest, really, the top 10 or 15 VC firms are generally scale in VC does seem to have some impact on return. But it's very hard for even $1 billion family to get into probably the top 3 or 5. They have the same institutional investors re-upping and re-upping, and it creates a difficulty. So getting into those could be hard. Right now, I think the data on private equity has not necessarily shown that bigger is better relative in the more recent markets. So this is not without some challenge, just capturing the illiquidity premium, and likely going through a fund that's also going to charge you about 2 and 20 is going to impact the net returns you're taking. So there needs to be a deep analysis. Do we want to be involved in these private markets? Do we have the resources to be a direct investor? Some do, most don't. Or should we capture part of this in an intimate part of our portfolio, small, by investing in funds? So we're going to jump into the hedging aspect in 1 second, but I wanted to take a little bit of that step back and get your feelings about what I said.
You're straight on. So much content in what you said, as well as some of the questions you raised. Let's start with venture capital. Venture capital is actually very easy in some respects. It's typically the 10 best to 15 VC firms in the world, and they're all well known. Sequoia, Benchmark, Lightspeed, et cetera, are the ones that consistently perform and perform and perform. It's a virtuous cycle and circle. So that part's easy. Identifying the best venture capital managers, very clear. We all know who they are. The trick is getting access. Now, how do you get access to a Sequoia? Well, you invest with them going back 30 years ago. That's when you build that relationship with them. Same thing with Lightspeed or Kleiner Perkins. So the best venture capital managers, very hard to get access to today if you did not have that access 10 years ago, 15 years ago, 20 years, or even 30 years ago. Again, back at my day job, what we do is just we maintain those relationships. We know they're great VC managers. And so our goal through every fundraising cycle is just to ensure that we're still there as part of their overall investment group that's in the next fundraising cycle they pursue. And in between those fundraising cycles, we spend a lot of time with those VC managers, just letting them know what a great partner we are for them, just to ensure that we stay a good partner with them. So that part takes a lot of work. Identifying the best VC managers, that's pretty easy. All that being said, there's still opportunities to find great VC managers out there. Maybe not necessarily in the US, but certainly in China, India, Israel. There's quite a bit of whiteboard out there. And in fact, as I think about our own portfolio, shifting away from the US to get more international exposure has been something that we've focused on over the last several years. So first, totally agree on VC. It is an access class as well as an asset class.
And one potential way to get in, if you can't get in directly, would be fund of funds. That's one option.
Fund of funds is one option. The other way is to pay attention to secondaries.
For sure.
Secondary market, sometimes, occasionally, and I do say occasionally, not very often, you will see bits and pieces of some of the best venture capital firms come out to the secondary market. It could be an institutional investor rebalancing. It could be an institutional investor that suddenly has a new CIO and he or she wants to rearrange the portfolio. Sometimes bits and pieces of the best VC firms are out there in the secondary market, and that's how you first get access. You buy a secondary piece, you introduce yourself to that VC manager, and then you continue to work with that VC manager, and hopefully you get part of the next fundraise cycle. Private equity is different. There are now thousands of private equity firms out there, over 7,500 at last count. Very different. If you go back to 1980, there were less than 20 private equity managers in the world. Now there are well over 7,500, going up to 8,000. So it's not a question of access. It's a question of finding really which are the best private equity managers out there. And it's been pretty clear now for a while that small to mid-sized firms, private equity firms, are generating that liquidity premium and earning the larger returns, the higher MOICs and IRRs that go with that. Now, why is that? Well, very simple. Small to mid-market companies is the less efficient part of the market. Again, think back to things that I mentioned earlier. Small to mid-sized companies probably don't have good access to capital. Private equity can bring that to them. They probably have a family ownership structure, which means probably could be bad governance. Private equity will help correct that. They probably have bad distribution. Private equity can help them expand their distribution channels. And probably they don't have the best operation structure. And again, a good private equity manager can help them build better operations and better cost savings. So in the small to mid-market size, there's so many ways to improve the operations of the company beyond than just showing up with bags of cash. And that's why small to mid-sized private equity managers are where the higher returns are being earned. And indeed, at Common Fund, that's where we spend pretty much all of our time.
And jumping into really the heart of the discussion, but I felt it was important to lay that framework, and that was wonderful, Mark. What is the right amount of beta market risk embedded in private capital portfolios?
And this is another difficult thing, is trying to understand how much market risk actually is embedded in an illiquid portfolio. Particularly if you're a CIO for a family office and you're trying to risk budget across asset classes, well, you cannot do that effectively unless you understand how much embedded market risk is contained in the various portfolios that you construct. So one of the things that we've been using for a number of years, starting with the Bass family, I began using this, and now at my current employer, something we called lag betas. And that's just simply a way to be able to measure that over time, what's the amount of market risk or systematic risk that's washing through a private equity portfolio or a venture capital portfolio. We all know that these portfolios are illiquid, which means that they get marked up or down less frequently than the public markets. The public markets get marked to market every day. That's what happens on the stock exchanges. All you have to do is look at your Bloomberg screen and you can see what happened to a mutual fund or a specific stock. But in private equity, venture capital, or real estate, those values do not get marked on a daily basis. They may not even get marked up or down on a quarterly basis. So it takes time that what we see happening in the public markets to wash through these illiquid asset classes. Well, we've actually measured this effect at Common Fund, and again, going back to my roots at the Bass family, where we began to look at this. And so I can tell you with pretty clear certainty that if you're trying to measure the full amount of systematic risk that washes through a private equity portfolio, you have to look at not only what's happening in the market this quarter, but the prior 2 quarters, and use that information to help determine what's the full amount of beta or market risk embedded in your private equity portfolio. In venture capital, you have to go back 3 quarters to be able to measure the full amount of market risk that's impacting that venture capital portfolio. And for private real estate, which is the least liquid asset class, you have to go back 4 quarters. So indeed, I've published a series of papers on this over the year, probably about, 8 or 10 of them for the Journal of Private Equity, Journal of Alternative Investments. So there's a lot of literature out there that shows you how you can measure these lag betas. And it's actually pretty simple to do. It sounds complicated, but it's not. You can do it in an Excel spreadsheet. And so again, pull down one of these papers, read through it, and it's a pretty simple equation. And it just allows you then to have a better sense of how much actual market risk is in your private equity portfolio or your venture capital portfolio or your real estate portfolio. Now, why is this important? Well, not only for the risk budgeting that I talked about, but you can't determine what's alpha until you determine what's beta. And so before you can actually measure how much alpha a private equity manager is adding to your portfolio, you have to strip away all the beta associated with that private equity investment. And so until you fully measure all the private equity, you cannot get a true measure of the amount of alpha that manager adds. So not only is it important for risk budgeting, it's important for deciding, does that manager really add a lot of value to your portfolio? How much alpha or excess return are they really bringing to the portfolio? I bet it's probably less than what they claim.
And that, yes, that's for sure. How can you decide what the beta exposure is? You mentioned lag beta, but I guess there's cap M. So there's a couple of ways potentially to measure beta, if you could explain them.
Sure. In the simplest ways, we use something called CAPM, the Capital Asset Pricing Model, invented by Bill Sharp, for which he won the Nobel Prize in Economics. And CAPM is a way of measuring how much market risk affects a stock price or a mutual fund or a bond. Well, you can use CAPM in the same way that you would measure the amount of market risk for an individual stock. You can use it to measure the amount of market risk embedded in your private equity portfolio. The one problem is the capital asset pricing model is just a one-period model. It assumes, and it is an explicit assumption of CAPM, that there is no illiquidity, that all assets are priced daily. That's an explicit assumption that was laid out in Bill Sharp's original paper. Well, that's not true in private equity or venture capital or real estate. They're not priced on a daily basis. You do not get to observe those prices on a daily basis. They get priced up or down over a series of quarters. Real estate, of course, is based on appraisals. Private equity is based on comparables. So it takes time to actually figure out what those valuations are. And that amount of time is not captured in the original capital asset pricing model because, again, it assumed that all asset prices are priced on a daily basis. And therefore, all you needed was a one-period model. The fact is private equity, real estate, venture capital are not priced on a daily basis. So you need a model that goes back in time beyond one day. And in fact, as I mentioned, for private equity, you have to go back 2 prior quarters. For venture capital, you have to go back 3 prior quarters. And for real estate, you have to go back 4 prior quarters. What does that really mean? It means, for instance, in real estate, what happened in the public markets last year is still having an impact on how private real estate is being priced this year. It's that long a time lag. In any event, these papers I mentioned all show how you can use this and build it in a spreadsheet.
So you mentioned the lag beta and going back, depending on whether it's VC, venture capital, or real estate.
Yes.
I mean, how do you apply that? Private equity versus venture capital versus real estate versus hedge funds?
So as an example, if you use just a one-period capital asset pricing model on venture capital, you'll come up with a beta that might be a little below 1x. Now, we all know that shouldn't be the case. Venture capital is a very risky, small cap intensive asset class. The beta should be much greater than that. But indeed, when you use all these lag betas and you accumulate all that lag beta up, you will find that venture capital prices at a beta of about 1.4 or 1.5, which is pretty reasonable. It should be pretty much where it should be. You should see more risk embedded in your venture capital portfolio than in the broad public stock market. But again, if you're using the capital asset pricing model, the one-period model, you won't capture all that systematic risk. You have to use the lag model to determine the full amount of beta associated with venture capital. Then when you know that, then you can start to talk about hedging. All right, now I know the amount of beta that's embedded in my venture capital portfolio that I need to hedge. So if I thought I could hedge venture capital by using the IWM, which is the Russell 2000 index ETF, on a 1-to-1 basis, the answer is no. You actually need to do it on a 1.5-to-1 basis. In other words, for every dollar of venture capital in your portfolio, you need to use $1.5 of IWM or small cap hedging to be able to have an effective hedge in your portfolio. And again, this is just a better way to understand and try and shrink that basis risk we talked about associated with the hedge.
Well, that was an incredibly important comment you made. We're going to dive into that. So that kind of was going to be my next question. What are some of the practical hedging ideas? Let's start with private equity.
So again, I started with the IWM, and that's the ticker symbol for the Russell 2000 ETF, and the Russell 2000 is the small cap index. And again, I'm just starting with an assumption that most investors' portfolios will be in the small to mid cap space, again, the less efficient space, and where more liquidity premium capture exists and higher IRRs can be captured as well. So using that, again, if you can understand what is the full amount of the beta embedded in either your private equity or venture capital portfolio, the IWM is a good place to start. It's small cap in nature. Mm-hmm. So again, if you're hedging a small cap based private equity portfolio, that's good. If you're hedging venture capital, well, that's small cap to begin with, by definition. So it's a good starting point. But then you have to be mindful, though, what the IWM represents. And so I'm just looking at a handout because I had put this together, looking at this myself earlier. If you look at the breakdown of the IWM, again, this is the Russell 2000 ETF, a little more than 21% of that is geared towards healthcare. Now, what happens if you don't have any healthcare private companies in your private equity portfolio?
Then it's not
fully
applicable.
20% of this hedge is being allocated to something that's not in your portfolio. Now you're
Right.
expanding that basis risk. The next highest category is about 17% is financials. Small mid-cap banks, community banks, small savings and loans. Again, if that's not in your private capital portfolio, you're introducing a hedge into your portfolio that's not hedging anything that's actually there. Industrials, about 15%. Infotech, technology, only about 15% actually of the IWM. So if you have a very tech-heavy portfolio, venture capital, and you're using the IWM to hedge it, well, again, you're not going to have a very close alignment. You're going to have a lot more basis risk because the IWM is going to be hedging healthcare and financials and industrials as well as infotech. And then utilities is another big category of the IWM. So starting with that is a good starting point. But bear in mind that if the IWM, this Russell 2000 ETF, does not resemble or does not reflect what's actually in your portfolio, you're bringing a lot of basis risk into that portfolio.
And diving in a little bit into that, and I know a very rudimentary question, but again, you never know the perspective of people listening in. By using something like the Russell 2000, the IWM, and you're talking about hedging risk, you're talking about shorting, which I suppose you could say if you're looking for an illiquidity premium in whatever venture capital, real estate, private equity, ballpark 300 to 350 basis points. But again, that's going to be very nuanced. You're again, along with fund fees, by shorting, you're spending money. So you're taking some of those profits off the table to hedge. And at the end of the day, if you keep on punching away at that, you may be looking at maybe 100 basis points above beta. And you almost have to wonder, is this really worth it?
So you raise a great point. What's the cost? First, let's be clear. A hedge is an insurance policy. When you put a hedge in your portfolio, you're trying to minimize your downside, protect against your downside. Well, that's the same thing we do when we buy an insurance policy on our cars or our homes. We're trying to protect ourselves against losses. And because it's an insurance policy, it's going to cost you. There is no free lunch with a hedge. There is always a cost associated with it. So let's take the IWM. And you're right. How would you hedge with the IWM? You would borrow it and you would short it. So you would borrow from a prime broker and then you would short it into the market. Now, first, there's a cost to borrow. Unfortunately, there's a lot of liquidity associated with the IWM, so the borrowing cost should be low. What's called easy to borrow or general collateral normally is priced around 50 basis points up to maybe 1% cost. But then you're also going to have to compensate the prime broker for the embedded dividend yield associated with those stocks. That's about 1.8%. So if you figure that the borrowing cost is, let's say, 50 basis points and the dividend yield's about 1.8%, there's your cost. It's about 2.3% per year to put that hedge on. And again, it's 2.3% times the amount that you're actually hedging.
Right.
So if you're hedging 100 million of private equity in your portfolio, that cost is going to be $2.3 million a year. That's a lot of money.
A lot of money.
It's a lot of money in my bank account.
Yeah.
So again, there is no free lunch. A hedge is an expensive proposition. So are there ways to simplify this or maybe make it cheaper? Yeah. Another way you could hedge this is you could buy a put option on a basket of publicly traded private equity stocks. So over the last decade, we've seen a number of large private equity firms, Carlyle, KKR, Blackstone, Apollo, go public. They're publicly traded stocks. You can buy and sell these stocks. You can also buy options on them. You can buy a call option on them if you expect their value to go up. But you can also buy a put option if their value were to go down. So if you were to take this basket of private equity stock and say, all right, that sort of reflects the overall market of private equity, I'll buy a put option on that such that if their market price declines, then that put option will become higher in the money. I can cash in my put option and that's my hedge. But again, you're buying a put option. That means a put option costs money. And you'll have to decide where you would buy that put option. Do you buy it at 10% out of the money? Do you buy it at the money? Do you buy it at 20% out of the money? And clearly, the closer you buy that put option to being at the money, the more expensive it will be. So, I did a back of the envelope calculation, looking at a 15% out of the money basket of these private equity firms, and it came priced out to a little over 3%. Now, right now, we have a higher volatility in our market because of the COVID-19 crisis, but still, that's even a little bit more expensive than the IWM. And even then, you still have basis risk. Because if you think about the Carlyle Group or Blackstone or Apollo, they invest not only in private equity, but private credit, real estate, energy funds. So they have a whole range of private equity investments. And again, that may not match what's in your underlying portfolio. So still a reasonably expensive hedge. And again, there's still basis risk. So you can see a theme here. The theme is it's hard to hedge.
Expensive.
And it's expensive. I'll mention two other things quickly. You could do leverage loans, a basket of leverage loans. And what you could look at are leverage loans that flow from private equity deals. And the way to do that is there are a number of business development companies, BDCs. These are mutual funds created in 1980. And there are a lot of BDCs out there that simply buy the leverage loans, the debt of private equity deals. So you could buy these BDCs or buy put option on these BDCs or short these BDCs because they're publicly traded. And that's another way to get some liquidity. And the cost there, again, back the envelope calculation, if you were to buy some put options on a basket of these BDCs, again, it's going to cost you somewhere in the range of about 3%. So still going to be reasonably expensive. And again, that's with a strike price at about 85% or about 15% out of the money. And yet again, you'll also have some basis risk because you're hedging a basket of leverage loans, not necessarily the underlying private companies themselves. So again, basis risk and costly. So what comes down to it is perhaps the fourth way, and that's constructing sort of your own custom index, which is looking at what's in your private equity portfolio, getting a sense not of necessarily all the individual companies, but what are the industries that you're focused on? It could be healthcare, it could be industrials, it could be consumer, it might be information technology, it could be financials. Figure out what are the primary industries that are in your private equity portfolio today. And there are a handful, there's more than that, there are buckets of exchange traded funds for specific industries. There are several ETFs out there geared just towards financials or consumer staples or healthcare. So build your own basket of these ETFs as your custom index, tailored directly to what's in your underlying private equity portfolio. Now you've shrunk that basis risk dramatically. And by building your own index, you should have a lower cost because it's more broadly diversified. And so the cost of that hedge should come down. So that's probably the best way to think about hedging. It's still going to cost you something, but by looking at what's in your underlying portfolio and then using a basket of ETFs to match the underlying industries in that portfolio, that reduces the basis risk and will help reduce the cost.
That's excellent guidance and probably one of your secrets. You're very talented at it. That's very helpful. So we basically did a relatively quick look at private equity. And we do have many other subjects we want to cover. But for someone that is looking to do something similar, more to their VC or their real estate portfolio, the same principles still apply.
They do.
For the most part. You just need to find the applicable benchmarks and indices, specifically if they're publicly traded, that match up best with what you own, that you're looking to potentially do option and putting strategies on.
That's exactly right. So VC, reasonably simple. I say reasonably simple. It's never that easy. But most VCs geared towards technology, information technology. It could be software as a service. It could be hardware technology. It could be Internet of Things. But again, most VCs geared towards that nowadays. And there are many ETFs out there that help slice and dice up the info technology space, that you can more finely tune the hedge, even more so with venture capital than you might be able to with private equity. Now, that's not necessarily going to bring the cost down, but it will allow you to be able to put together an effective hedge for the portfolio. Keeping in mind, there's no free lunch. A hedge will cost you money. Real estate, same thing. There are a whole plethora out there of REITs, real estate investment trusts, that you can buy that will match up with your underlying illiquid portfolio. So again, you can reduce that basis risk reasonably effectively by using REITs, but at the same time, it's going to cost you something, either in shorting those REITs or in buying a put option on a basket of them.
That's for sure. Great advice. We are going to get into gold, Bitcoin, and a little bit about liquid securities as well. Before we do that, and I know I usually save this for the end, but I have my reasons. I'm going to do about 90 seconds effectively on, if I could call it the sponsor of today's podcast, and that's my organization, Family Office Association. So to give a little bit of context, I'm the founder and CEO at Family Office Association. We're among the most tenured and largest of the true membership organizations dedicated to families of great success and their single family offices. We do a significant amount of proprietary content, perhaps as much as anyone in the world, and we've been incredibly active during COVID-19. And we host events around the world. Now with COVID-19, that's a bit on hold, but you adapt, right? So Monday through Friday, we host video meetings for our members. We'll occasionally invite some guests and family offices to be more familiar with us, like we're doing in this call. We do peer-to-peer. We do a level of consultative services. We do online peer-to-peer with a global community. Really what I'm getting at is if you're finding this kind of dialogue to be great, to be really valuable for you, and all the guests that I have on, from Jeremy Grantham recently to Peter Diamandis next week to former boxing legend Larry Holmes about leadership and tenacity. I've been very, very fortunate to have had great, great guests on and upcoming. You really have to look into joining, to being a part of Family Office Association, to be supportive of what we're doing and the value that we provide to families and family offices. So wanted to give a little bit of 90 or so seconds to that. That means I won't have to mention it at the end. So that will be good. And on that note, Mark, let's continue. I guess a pretty obvious one when it comes to hedging, you really can't have a discussion without at least bringing up, is gold a hedge for not only just private equity that we spent a fair amount on, but other asset classes as well?
Yeah, this comes up quite a bit. Everyone likes to think that gold is a great hedge and sort of the maybe even the best of hedges at times. First, let's be clear. It's another insurance policy. And it is costly. People tend to scratch their head on that because they think, gold, no, that's not. That's an investment. No, it's an insurance policy. Let me explain why. If I were to ask the audience right now, what's your expected return for gold? I bet I might get a lot of blank scares. And the reason for that is there is no expected return for gold because it's not a productive asset in the sense that there's a cash flow associated with it. For a bond, a stock, a private equity investment, even venture capital, real estate, there is cash flows associated with that underlying investment. Not so for gold. Gold does not have an embedded risk premium, so you can't develop an expected return from it. So when you buy gold and you put it on your balance sheet, that means you have to displace other assets that do have a risk premium associated with it. Let's say you're going to make an allocation, a 10% allocation to gold, and you're going to sell off 10% of your equity portfolio to do that. Well, you've just given up the equity risk premium that is attached to public equities by allocating to gold. So that's your trade-off. Yes, you put gold as a hedge on your balance sheet, but you've given up the equity risk premium or have swapped that out. And again, people debate this with me all the time. And so I come back and say, fine, build me an expected return model for gold. And that's a very difficult question to answer because there is no expected return model for it. It really is what other people will pay for it in a moment of crisis. And that's indeed why people invest in gold. It's an asset that we hold, not because it's providing us with a cash flow today or it has an expected return. We just expect its value to spike up when we hit a moment of crisis because it's a precious, scarce commodity. And what we hope is that someone else will be willing to pay more for it when that crisis hits. And so that's the reason why it's an insurance policy. There's no expected return to it today. To buy physical gold and put it on your balance sheet, that means you have to trade out of an asset that does have an expected return associated with it. So when I mention this, people come back and they say, all right, Mark, well, I'm not going to buy physical gold. I'm going to buy gold futures. Okay, you can do that. But then I ask them, have you ever looked at the gold futures curve? Is it in backwardation or contango? And of course, when I use those terms, people's eyes begin to glaze over because those are such arcane terms. Most people have not heard of them. Don't blame me, blame John Maynard Keynes, the great British economist who came up with those terms. He just created them out of thin air. But a contango market just means an upward sloping yield curve. And that's the gold market. The gold market is always in contango. So what does that mean? That means if you're going to buy a futures contract, you're buying it out in the future at a high price, and because gold matures over time or erodes over time, at some point that futures contract matures. And so you have to close it out. And what do? Well, if you're selling gold up here as a hedge, you have to buy it down back here at the lower end of the curve, which means you're always selling high, buying low, and then rolling that hedge, selling high, buying low. That's the nature of a contango curve. It's called negative roll yield. Gold is always in negative roll yield. So if you're using the futures market to buy gold or to hedge, what you're going to find is that you're going to lose money on that because of the contango market of gold. So in any event, it just gets back to the point that there is no free lunch on a hedge. It's always going to cost you something in your portfolio. So be mindful of that. And then it's a trade-off. How much am I willing to spend on the hedge to give me that production that I need in my portfolio?
I don't want to get too far off the hedging focus, but in gold, I almost can't help but ask, given again, from the CIO to among the most iconic families ever to your current role, your opinion, even though what you said should perhaps physical gold, but let's be broadly gold, should it likely still be an allocation in a wealthy family's portfolio, 1% to 3%, or it sounds like you're a little more negative as to why?
So two things. First, in my contango curve explanation, I actually got that wrong. When you're hedging gold and you're buying the future, you're buying high and selling low at the bottom. And that's what's called the negative roll yield, and that's where you lose money. Again, with gold, I'll tell you, at my personal level, I don't own gold in my portfolio because I'm aware that it is a wasting asset. It displaces an asset, another productive asset that I would otherwise accumulate in my own personal portfolio. And based on the fact that we have this upward sloping contango curve, I know that there's negative roll yield. So if I'm trying to buy gold in the futures market, it's a losing bet. You will absolutely lose money for that reason. So from my point of view, I want every asset in my portfolio being productive for me, which is why I'm not a proponent of gold. That being said, it is the ultimate parachute. And indeed, if you are going to buy this ultimate parachute and you're going to hold gold, you hold it in what's called a bullion bank. And there's several in the United States, Hong Kong, London. And my suggestion would be, if you're thinking about that, think about where is the center of currency trading in the world, and that's London. So if you're going to hold physical gold any place at a bullion bank, London's probably your best bet because eventually you do need to convert that gold into some currency. And best to do it wherever the center of currency trading exists in the world, and that happens to be London. And you can hold gold either separately inventoried or as part of a bigger pool of gold in these bullion banks. And the reason that I mention that is because if you have your own gold in a bullion bank separated, you pay extra for that insurance that inventory taken, and that segregation. So there's actual costs to storing gold and insuring it with a bullion bank, on top of it being a wasting asset on your balance sheet.
Not to make it even more complicated, but why not? If you have strong feelings of being tactical on an incredible deflationary environment, or perhaps hyperinflation, two extremes, could I make the argument that gold could be even more valuable if that's if that's what you're leaning towards agreeing as what is likely to happen?
This is a great point. So take everything I said so far with a grain of salt, or maybe a cube of sugar. What you've just raised is a great point. One of the things I've looked at is the correlation of gold prices with inflation, and it's positively correlated. So that means as inflation goes up, the price of gold goes up, and that's a good thing because it then provides you as an inflation hedge. I've not done a study on deflation because there are very few instances on that. But I think that would also be cause for concern if you're holding on to assets that are deflating in value. Gold might be, and I underscore might, be another way to hedge deflation. And now we've not seen periods of deflation in the US, except in the Great Depression. But bear in mind, it's fascinating. We've only been allowed to own gold privately now for the last 40 years. If you recall, going back many, many years ago, it was illegal for private citizens of the US to hold gold. And this goes back to the Great Depression. So here's a favorite question I love to ask people. Who's the original hedge fund manager out there? People like to think, oh, maybe it's George Soros. Maybe it's Paul Tudor Jones, or maybe it's Alfred Winslow Jones. And I like to say, no, the original hedge fund manager out there was none of those gentlemen. It was Franklin Delano Roosevelt, our president. And why is he the original hedge fund manager? Because back in the Great Depression, he introduced something called the New Deal. In order to do that, he had to expand dramatically the monetary supply of the United States to finance all this. Now, back then, our dollar bills were backed by physical gold. You could turn in a dollar bill for gold. And so what did he do? We knew that if he was going to expand the money supply, people were going to hoard gold. And so he outlawed the private ownership of gold back in 1933. And he confiscated all the gold in the US. You were required to turn in your gold back then. And he bought it in at the US rate, which was like $22 an ounce back then, and then promptly marked it up to the global rate, which was like $36 an ounce.
Yeah, of course.
It was a perfect global arbitrage that he was able to do by direct decree or executive authority under the government. And so we were still on a gold standard until Bretton Woods. And then finally in the late 70s, we were allowed to own gold privately again. But for many years, it was not only an illegal activity, it was a financial punishment if you were holding physical gold. So with all that in mind, that was just a demonstration that back in the Great Depression, when we did have a period of deflation and Roosevelt was about to expand the monetary supply, he understood the mechanics and dynamics of gold and he confiscated it. So yeah. If one president, a famous one, and one of our best presidents ever, could understand the value of gold in a crisis like that, maybe there's something to it.
Yeah, that's, to me, and yes, I'm familiar with that from 1933. That's very concerning. And other subjects that we covered at my podcast are effectively government confiscation, which is taxes. Don't worry, Mark, it's not going to be my discussion with you, but
Good.
These are the things that the big families, especially outside of the US, in countries where it is a little bit more wild, wild west, and governments could do what I'm going to call illegal or confiscatory type actions. This is horrific. And this is, again, why the family hedging and remaining wealthy and having diversity in global assets, all of that, especially for international families, is even more and more important. Hard in today's world to have a discussion about gold without segueing into Bitcoin and other cryptocurrencies from the perspective of hedging. So
people think, Bitcoin or cryptocurrencies are a perfect antidote to things going wrong in the broader financial markets. First off, Angela, let me ask you, do you trade in any cryptocurrencies?
I do, yes.
Okay. Most people don't. But when I ask people in an audience how many people trade in cryptocurrencies, I might get, a smattering of 3 or 4 hands. But the fact is we've all been transacting in cryptocurrencies for a long period of time. So let's describe what a cryptocurrency is. First, it's an electronic currency. Second, there is no physical denomination of it. Third, it's tracked by a computer algorithm. A computer algorithm determines its value. Fourth, there's no central bank intervention. And then fifth, again, because there's no physical currency, everything's digitally tracked. Now, I just described Bitcoin to you, but also just described frequent flyer miles. Delta, United, American, Southwest, they all have cryptocurrencies, which are just called frequent flyer miles. Points that you get on your credit card, the same thing. The difference with Bitcoin is that it took a closed system. So at United, you can only use your frequent flyer miles for United flights. You can't port them over to American. The same thing at American. You can only use your frequent flyer miles for American. You can't port them over to United. Bitcoin opened up these closed systems and said, let's invent a cryptocurrency that can be used for any number of purchases. And that was the brilliance of Satoshi Nakamoto, which, by the way, is an alias. No one yet knows who this person or group of people are. It's one of those fascinating things that at some point will be revealed, but we're all waiting for that. So meanwhile, though, from Bitcoin, we now have literally thousands of cryptocurrencies out there. Many have come out through what are known as initial coin offerings. As a data point, in 2018, there were 7.8 billion US dollars raised through initial coin offerings, which are small startup companies offering or issuing their own coin, or token, as it's sometimes called, to help raise capital to finance their research. That's come down quite a bit in 2019. We went down to only about 400 million in ICOs that were raised. But what's happened is the venture capital industry has come in significantly. In 2019, about almost $3 billion of VC dollars were raised to support blockchain technology. So I think it's less a hedge and more an investment. Now, I'm not necessarily a proponent of cryptocurrencies, but the underlying technology, the blockchain technology, does have a number of applications. So consider this whole integrated nature of one ledger that brings all the information together, how that would simplify, foreign exchange trading. That, Angela, you and I could just quickly swap dollars for pounds across our computer screen through a Bitcoin connection, as opposed to having going through our banks. Think about all of us that own real property. What's the thing you do at every closing, whether it's a personal residence or an industrial property? You do a title search. Why do you do a title search? Because the records are scattered all over the place. They're arcane and they're somewhat secretive. So you got to hire a title search company to do that for you because you can't do it yourself. Well, what would happen if we took all the real estate records and we just integrated them in one ledger and we could all access that? Well, first, it would put all the title companies out of business. And second, it would lower the cost of title insurance we all have to pay. So there are a lot of legitimate uses for blockchain technology out there. Immigration records would be another one. Many ways for this technology to be used and to enhance our lives. And so I do believe that blockchain technology is something to look at as an investment. Be very careful, though, with coins. The volatility of them is extreme, as we've seen with Bitcoin and others. And to be blunt, many of these coins lose value very quickly. And so just as a data point, of the top 15 initial exchange offerings, so these were initial coin offerings offered on a cryptocurrency exchange, of the top 15 from 2019, 11 have lost money. On average, they're down 53%. 4 have made money, on average about 200%. So a lot of extremes there. You can lose a lot of money very quickly and you can make a lot of money quickly. So be careful, would be my word there. I'll stop there. I'm sure you have other questions.
Oh, well, I'm going to dive into that one a little bit. Everything you said is, of course, true. But if I could argue it potentially a little bit or get your opinion, and I am very much far from a crypto expert, but if I were to, I don't have a $100 bill on me, but if I were to take out a US $100 bill, the actual paper is like a penny. So it's worth $100 because it's backed by the full faith of the US government. which again, I'm using the most powerful country on earth. But for many other countries where their currencies are, for the reasons I noted before about politics and just how things are, could I make the argument that I'm hedging a level of risk in my own country by doing something with Bitcoin, maybe more specifically than the others, for the reasons that I noted?
Possible. You can make that argument. So it's interesting in the cryptocurrency world, they are using the expression fiat currencies to refer to the dollar and the pound, the yen, the euro, et cetera, which is just that they are backed by the full faith and credit of the government and the hopeful, thoughtful application of the central banks of those governments. But you're right. As I mentioned before, we're no longer on the gold standard. That stopped with Bretton Woods back in the early 70s. We fully came off the gold standard at the late 70s. So, our dollar bill is only backed by the faith and credit of the United States, which fortunately is pretty good. But you know what? There are periods of hyperinflation that still exist from time to time. Argentina has experienced this. Certainly, we're all famous case of Germany in after World War I. So, you can make an argument for that. But I would note, and I'm going to push back a little, this is a quote I'm going to read from. This is from an offering document for an ICO. These tokens do not have any rights, uses, purposes, attributes, functionalities, or features, either express or implied, including being able to sell, use, pay, or cash in the value of these tokens. Now that's straight from a disclosure document for a recent ICO. Basically what they're telling you is these tokens are only worth what someone else is willing to pay for them. But you have no right to come back to us, the company, and ask us to cash them in for you. In fact, most tokens are structured that way, that they have no claims on the cash flows of the company. So in fact, one of the things I did is I wrote a paper on ICOs a couple of years ago, and I just looked at the capital stack for your average company, where you start with senior loans, then debt, then you go into preferred equity, then stockholders' equity or common equity. And then I had tokens at the bottom of all that. And the term I gave for it, I called it subordinated equity, which means after all the money is paid out to your debtors, your creditors, your bondholders, your preferred equity holders, and your common shareholders, what's left over after that, if anything, is what's left over for the coin holders. And so, again, for most of these coins, there is no claim on the cash flows of the company. You don't have an ownership stake. You're really buying something just because you believe that it will increase in value or someone else will pay more for it. No, Angela, I apologize. We were briefly interrupted here. That was my team letting me know that I'm going to have to move on. So if we can wrap this up in just the next few moments, and I apologize for having to bring this to a close.
Yes, if I could get your opinion in 30 seconds, and it's a tough one, by the way, and taken from Nicholas Nassim Taleb, being anti-fragile, perhaps profiting during times of turmoil, volatility, and challenge. An 80-20 portfolio, 80% hyper-conservative, and 20%, forget the middle, incredibly aggressive. Even if you lose all of that, you'll have 80% of your capital probably growing at whatever 2, 3, 4%. Would you ever recommend that as a strategy?
Again, now I'm speaking as Mark Anson, not Common Fund. No, that's a barbell, but it's an interesting barbell, right? What you're doing is you're saying, I'm putting a call option out here on just aggressive growth, and I'm putting in this foundation of stability behind it in case that call option just turns out to be valueless. And so I'm still going to have 80% of my wealth, and I'm doing a call option just to pick on it. My view is you really do need to structure a full portfolio across all the asset classes. And build into that, first understand what is your overall risk tolerance, and build your portfolio from there. And that means you should consider even things as boring as bonds. And people hate to talk about bonds right now. They are so boring. They are so low interest rate generating. I hate them. Why would I even put them into my portfolio? Well, they're a shock absorber. Yes, the return on them is going to be small nowadays, given where interest rates are. Fully acknowledge that. but they do provide some shock absorption when we hit that speed bump. Gold is, again, another shock absorber. The problem with that is you don't collect anything on it until you hit that speed bump.
And
so again, when I think about hedging a portfolio, I like to find things that actually yield something while also hedging the portfolio at the same time.
that would be the best way to do it. I want to be respectful of your time, Mark. I'm going to give about a 2-minute wrap, but you could feel free to exit. Everyone, we're very fortunate today to have Mark Anson, A-N-S-O-N, CEO and CIO of Common Fund. Feel free to learn more about the Common Fund. What's a website, Mark, where they could learn more?
It's www.commonfund.org.
Thank you so much. Again, please feel free to exit. Thank you for your time. I'll do about a 1 or 2 minute wrap. So those that want to hang on, and we're all good.
Thank
Again,
you,
Mark, thank you so much. Thank you.
Bye now.
And everyone, we're very fortunate today, as noted, to have Mark Anson. I did have more questions in the tank, but time was going to be a little bit tight. Originally, it was going to be only 30 minutes. So to get right about 61, 62 minutes was twice as much time as kind of allotted for. I would have liked to have gotten, although it's more basic, a little bit into liquid securities. And he probably would have went into futures, options, but gold and crypto possibly could have played into that. VIX futures. And so there's a variety of strategies, but again, we'll have to save that one for a different time. I thought today was fantastic. I hope you enjoyed it. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles' Effective Family Office podcast. And as noted earlier, the founder and CEO at Family Office Association. You could follow me on social media, very active on YouTube as Family Office, on LinkedIn as Angelo Robles and Family Office Association, and on Instagram as Family Office Association. Website is familyofficeassociation.com, angelorobles.com, and preferred email, angelo@familyofficeassociation.com. Thank you all, our live listeners and participants today. We hope you also enjoy it eventually when it's up on YouTube and multiple weeks out up on our podcasting channels, which the main ones would be Apple, iHeart, and Spotify. Thank you, everyone. Have a great day.